Hi, everyone, and welcome to Streaming Media Connect 2024. I'm your host, Evan Shapiro, your media cartographer, if you know me from that angle. There's going to be a ton of great programming all week here at Streaming Media Connect, Monday through Thursday, chock-a-block full of great panels and keynotes and Q&As and information sharing, as always, with streaming media. Thanks so much for joining us. I'll get to my keynote in a second. I'll be joined with some guests. But before that, just a few housekeeping notes. The first person to correctly name the act and the piece of music playing in the walk-up time on this panel and be here present at the end will win an Amazon gift card worth $50 from Streaming Media Connect. But you must be present to win, Warren. So stick around. And if you come to two or more sessions this week, you'll be entered to win an OBSBot Tail Air AI-powered 4K PTZ streaming camera. I do not know what that is, but it sounds super cool. And you'll be notified after the event. Steve will drop all the explanations on everything in the chat here. Please put your Q&A in the Q&A section, chat in the chat. Look for links to LinkedIn bios and other information in the chat from Steve. This session today is the first of many all week. Please go to the link in the chat to look at the entire agenda, and all the videos will be posted on YouTube later on in the month. And then this session is the opening keynote. So I'm about to go through all of the fourth quarter earnings reports that have come out in recent weeks, not for the entire earnings season, because earnings season still continues on. But after that, on this very stage here, or virtually on this stage, I'm going to be joined by a panelist of Blue Ribbon honorees, I believe. They'll have to show us their ribbons when they jump on here. Ophelie Boucaud from Dataxis, Paul Erickson, John Giegengack from Hub Entertainment Media Research, and Alan Wolk, the TVREV namer of the thing called FAST. So they'll all be here at the end to rip apart my performance during this keynote. Stick around for that, and there'll be a Q&A with all of us on the other side of this to go through some of the insights that we may have gained during this session. Okay, I guess guesses are going in the chat, and the bios for all our experts are all there. So great, I'm going to jump in. There's over 100 of us here, so thanks so much for joining us. I'm glad I vamped for as long as I did. Share screen. I'm hoping that you can all see my screen. Yes? Okay, great. Yes, I'm seeing thumbs up. Thank you for that vote of confidence through emoji. So this is the Media Universe map. You know, if you know me, you know this map. Then you also know that I typically remake this map by hand in PowerPoint twice a month, which is as painful as it sounds. I did this yesterday, hunched over a table on a nice day outside, and went through this. And it's an interesting update every time I jump into this. First and foremost, I love to zoom further out and look at the total market cap on the map itself. So there are 125 companies on the map-ish. They total about $17 trillion in total market capitalization. And this is an earnings call, an earnings season keynote. So everything's going to be about market capitalization, its stock valuation relative to the performance of each other. And that's how this map is sized by math, using publicly available data on market valuation and other valuations that have come through private offerings. The total market cap on the map is $17 trillion. The Death Stars alone account for 12 trillion. So the 6 Death Stars of Microsoft, Apple, Amazon, Alphabet, Meta, NVIDIA now account for 12 trillion of the 17 trillion, or 73% of the total market share of all the companies represented on this map. That's one of the things that I love about zooming out here, is to show just how influential big tech remains. It has become and remains in this new user-centric era. One of the key elements of the thesis I'm building right now in media is that big tech won 5 years ago, and that the solidification of their power continues to define the user-centric era. we'll look now at a lot of the companies that are performing inside this ecosystem on the playing field set by the big tech Death Stars. Some of whom are doing quite well, and others who are looking for their way. We'll start with one of the earliest every quarter to announce their earnings is Netflix. You can see net income skyrocketed for them in fourth quarter. Now, that's because they had very little net income a year ago in fourth quarter, or in 2022 in fourth quarter. So a lot of this reporting does wind up being simply year-on-year comps. And that'll be a theme that we'll talk about a lot. But that said, they're spitting off a ton of free cash flow now. They have become very profitable, unlike every single other player in the streaming ecosystem, including Apple and Amazon. It's very doubtful Prime is a profitable business. It's extremely doubtful that Apple TV Plus is a profitable business. And everybody else in the streaming wars who have lost to Netflix is hoping to be profitable at some point in the next year in streaming. Meanwhile, revenues and subscribers were up a lot. They're just short by comparison to net income. When you look at the full year, which is always a useful thing, when you're actually reading the earnings reports versus just reading the cut and paste press releases in analysts and trade publications, you know that this is the time of year that companies traditionally report both fourth quarter and full year. And when you zoom out and you dig into the full year of the companies, it shows kind of a different level of health. Yes, without question, Netflix had a great fourth quarter with regards to revenues and net income. But that is also true for the entire year. So the subscriber increase is the same either way, 13%. But the revenues for the full year went up 7%. What's interesting here is that net income jumped at more than twice that rate. And so this was a year where they retrenched on their operational aspects of their business, but also were able to take the revenues in the second half of the year and turn them into a great net income story for the full year. This is a company that's operating on all cylinders. They signed up 13 million, a record even for them, new subscribers in fourth quarter of last year. Their churn remains at an industry low, under 2% on a month-to-month basis. And there is no sign that subscribers are really rebelling against the password lockdown that Netflix started, and now everyone else is following them last year. In fact, just the opposite. It seems like a huge percentage, I would say probably north of a third, probably closer to 40% of folks who shared logons with their families and friends are now signing up as either kind of shared account members at a lower price or full members. And a lot of them, a big percentage of them, are signing up for Netflix's ad tier. That said, Netflix's ad tier remains remarkably, remarkably small. So all of this great story is produced by one thing, which is subscription revenue. And the ad tier doesn't yet produce a material amount of revenue, and that's quoting their CFO. The issue is usage. Not only are very few subscribers signing up for, or have they signed up for the ad tier relative to the monthly average users out there in the ecosystem. Netflix announced 23 million monthly active users in the fourth quarter of last year. That's less than 25% of what Roku channel has. But secondarily, the overall usage on the tier isn't yet producing enough impressions to generate real income. We'll see what happens as the year progresses. They just raised their overall price for their ad-free tier to I think the most expensive single offering in the marketplace. And so that's probably going to drive a number of subscribers into the ad tier in the first half of this year. We'll see what happens. This is a big upfront for Netflix. They have to get their ad business right if they're ever going to get their ad business right. And usage is a big challenge for them. If they're able to show month-on-month increases in both signups and usage on the ad tier, I expect them to have a good upfront. That's a big if. Their stock is at a 52-week high, and the Wall Street seems to think they're headed not just in the right direction, but in the only one headed in the right direction in their streaming cohort. Roku had an interesting earnings report. They had a really good story in fourth quarter to share. They lost money in fourth quarter, and as they did for the year, but they were able to have the loss from the quarter a year ago. So it was a improvement of 58%. Their revenues were up. They signed up a tremendous amount of new activations, which is a different thing than a monthly active user for a FAST channel. An activation in a household means someone's turning on a Roku TV set. So that's an impressive number. They got into the devices business in a different way, in a big way, with their own connected televisions at the beginning of last year. And it seems to be working incredibly well for them. They're selling a lot of devices. Devices are I think about 25% or a third of their overall revenue. Ad inventory is their number one revenue generator. And they had a very good second half of the year from an advertising standpoint, which would seem to indicate that that the advertising economy is bouncing back in this space, in particular, connected television and digital video. However, despite these, what I think relatively, let's say, middling to good numbers, Wall Street really pounced on Roku after their earnings call. And if you read their earnings report, there's three words that I think are the cause of that. They use, actually, it's the same word three times. They use the word uneven to describe the ad market. Despite having a really good second half of 2023, Roku said that the ad economy was uneven three different times in writing in the earnings report. And then that was quoted by analysts all around the industry. And their stock fell, I think 17% or 15% overnight as a result of that, which I don't think is necessarily fair. Until and unless maybe you zoom a little further back. And you look at the entire year and you see, yes, the households increased 14%. Revenues are up almost 12% for 2023. And yet they lost a tremendous amount of money in 2023, despite rounds of layoffs. And so net income dropped 49% for them last year. This is a very crowded business that they're in. FAST is a very crowded business, but Roku does much more than FAST. They are an OEM. They are a television operating system and manufacturing platform. And they have a very competitive set, not just Samsung and LG and TCL and Hisense, but also Google and Amazon. Amazon's actually the number 2 share of voice in the operating system CTV ecosystem in the United States. And in many territories, Amazon is in the top 3 and Google is in the top 3 as well. Whereas Roku is limited mostly to North America and Latin America. And so expansion really has to come in the US. And if they can't continue to conquer this market and improve their bottom line at the same time, their share is going to be under attack by some of the largest companies in the history of corporate America. And so I think somehow that might be built into this. Also, there was an announcement that Walmart might be buying Vizio. I think that offers yet another huge potential competitor in the space. And that probably explains some of their market performance, but I don't think all. I think Roku has a better story right now than a lot of folks in this space. And I believe that there's a good deal of unlocked value there. Comcast had a very good fourth quarter relative to the whole. Their overall revenues were up 2.3%. Their net income was up pretty high, and a good deal of that, and this is a recurring theme, came from overhead cuts that the company had made throughout the year. They also had a very good quarter in parks, and parks is something that Disney and Comcast have in common. It's great. It's a constant generator of revenue and, by the way, net income. And that's, you can see the influence it has on both revenues and net income here. However, it isn't a massive growth curve. Some of this is based on year-on-year comparisons, and quarter by quarter, it's an uneven trajectory of growth. However, when you zoom out and look at Comcast's full year, their net income is really, really interesting. They had a massive increase in net income, but a good deal of that is driven by a write-down that they took of around $9 billion, which I believe is their write-down on Sky that they took the year prior, but didn't realize the adjustment until last year. I think that's it. Do not quote me on it, but at first look, you'll see net income at 207% growth. When they adjust it, it gets into the 2% range. And when you look at this chart, what you see is the major issue facing Comcast right now. Their entertainment division is doing okay, and Peacock is cutting its losses and increasing its subscribers. But the real issue here is in the core Comcast business itself. The total customer base for Comcast is down year on year. Their video subscribers are obviously down, shedded 13% last year, which is just massive. But crucially, broadband homes shrank in 2023 for Comcast. Not only did they not grow, but I almost fell there. Not only did they not grow, but they shrank. They lost broadband connections in 2023. Their revenues were basically flat, and their net income is not really growing at a pace that you'd want to see. That said, Comcast has a tremendous number of advantages. Most notably, they do have 30 million broadband homes in the US, the most valuable homes in most of the media ecosystem. Secondarily, a year ago, they got into a joint venture with Comcast around their Xumo platform. And it does look like this is yet another competitor for the connected television pie. The difference here, though, is when you look at mobile, Comcast and Charter are the two fastest growing mobile providers in the US. And they are reconstituting the triple play that is disintegrating very quickly, the protective shell around media and entertainment in the home over the last, let's say, 30 years. They're rebuilding it, replacing telephone with mobile, and replacing the pay TV ecosystem with a streaming TV bundle of services. Xumo and mobile promise that kind of new triple play, and Comcast and Charter both kind of really desperately need that new triple play to work. And you can see why here. This is repeated, and also Comcast's market cap since the beginning of the year is down, not dramatically, but is down based on this same analysis. And the doubling down of the same story by Charter. Again, well, let's pause here. Charter fought a massive battle with Disney at the end of last year. Spectrum Cable, which Charter owns, did. They went dark with all the Disney channels, including ESPN during the US Open and during baseball season and during the start of football season and college football season, going dark on some major sporting events. And Charter won this battle. I think it's safe to argue. They came out with the things that they needed to continue as a going video concern from one of the most significant video providers in commercial pay TV business. On the other hand, it really hurt their subscriber numbers, and their overall business is really facing some major headwinds. When you look, they're facing the same problems. They actually were growing broadband homes through the first half of last year, and then they hit a wall. And they, like Comcast, are experiencing not a slowdown, but the beginning of loss of broadband homes. You can see their total customer homes are down for the year, and their video homes are falling, not as fast as Comcast, but dramatically down. And then you can see that mobile business that's growing like a weed for them and is incredibly successful in keeping whole home customers around, retention of new signups. But they need that business not just to continue to grow, but really wrap around the Xumo business to help their bottom line, which was not a good story for the full year 2023. They're at a 52-week low in market capitalization, and I think this chart pretty much explains why that is. On the other end of the spectrum, again, this goes to this kind of weird lens that the trade media and analysts seem to peer through when they look at these companies during earnings season. They tend to really listen to what the CEOs say and look at the press releases, and then take the press releases and put them in ChatGPT and then regurgitate them in their social feeds and on their platforms. And that's how a hive mentality gets around this. Alphabet's earnings report was met with a meh, basically, by Wall Street. I think their stock went down in the 24 hours after they reported earnings. And yet these numbers, I mean, I think, as we were just looking at Comcast's, are the envy of many of the people in the media universe right now. Their cloud business is up almost 26%. YouTube was up almost 16%. Search is relatively flat in the entire historical continuum of Google's search business, but their overall revenues were up almost 14%, and their operating income was up just a tremendous amount, over 50%. Year on year in fourth quarter, which means a couple of different things. One, the YouTube growth in particular kind of portends the rebound of the overall ad economy, especially and almost exclusively for digital players. On the other hand, Alphabet was able to do something that a lot of folks in the rest of the media ecosystem are struggling with: make cuts, sometimes very painful cuts, from an employee standpoint, and grow revenue and operating income at the same time. Some folks are now hyper-focused on free cash flow as the metric of success, whereas their operating income and their revenues are both either flattening or down. That's a dangerous spiral to get into. Google, on the other hand, because they have such an interesting and diversified revenue flywheel, really can create results on an ongoing basis that allow them to expand while reorienting huge chunks of their business. And so they're retooling this business around new areas as they are facing headwinds from a regulatory standpoint and a legal standpoint in advertising and in search and in other platform businesses. They're expanding greatly into connected television and the cloud business. And you can see, the revenues were up almost 9% for them, but the net income was up 23% for the entire year. So I think, despite all of the various challenges that they face with regards to courts and legislatures around the world, I also think that Alphabet's going to have a massive year this year, especially because they are now the fourth largest MVPD in the United States. Their YouTube Premium subscription business just crossed 100 million users, and they are the fastest growing operating system inside connected televisions around the world, and the largest ad platform on the planet Earth, and the second biggest music platform on the face of the earth, and the most important kids channel on the face of the earth. So this is the diversification of business models and revenue sources for Alphabet really protects them, I think, from downturns in any one segment. And that's why their market cap is up 54%. They're near or at an all-time high in market capitalization right now, and I think deservedly so. On the other hand, Spotify really just defies my own internal logic and gravity. They had a great fourth quarter. By a lot of measures, they had a great 2023, no question about it. Their net income was up almost 70%. But for Spotify, that's like saying they grew a couple inches from kindergarten through second grade. Net income is not a great metric to measure Spotify historically by, and I'll talk about that in a second. Their revenues, however, were up. Their advertising was up, although still a paltry share of their overall revenue, and their sub-revenue was up 17%. So, relative to their own historical record, and again, a lot of this, especially in net income, is just year-on-year comparisons. It's really easy to look taller than a poodle. On other metrics too, MAUs, ad users, subs, great growth. But in the face of all that revenue growth and in the face of all this user growth, this story keeps happening. Their net income was down 24%. They lost over, I believe they lost over $1 billion. No, they lost $500 million in 2023, more than $500 million in 2023. And it's worse by 24% than the year prior, despite revenues being up 13% and usership being up across the entire board. And by the way, this net income worsening happened despite, I think, 3 rounds of layoffs in 2023, including the last round where their CEO threw their CFO under a huge spiky wheeled bus and blamed that person for everything that ails the company, as opposed to the $2 billion they sunk into podcasts with very little to show to it at this point. They did just announce that they're re-upping with Joe Rogan for $250 million, which makes sense because they need their advertising business to continue growing. And they're unlocking the Rogan show across all other platforms and will rep all the advertising across everywhere the show goes. A much better business than locking him exclusively behind a paywall on Spotify and only getting the ads from that platform. On the other end of the audio spectrum, oh, by the way, so despite this number, this big red chunky number on the screen here, Spotify's market capitalization is up 105% year on year. I understand this is a very tempting slide to look at, but on the other hand, so is this. Anyway, at the other end of the audio spectrum, Sirius signed a $100 million deal with the Smartless guys in a very Howard Stern-esque construct. If you'll remember, they signed Stern and everyone said, satellite radio, what the fuck is that? And then years later, both are doing quite well. However, 2023 was not a great year for Sirius. The Smartless deal is, though, not just for a podcast, it's for many other programs as well. That's what makes it Stern-like. Looking at 2023, fourth quarter was a shitty quarter for Sirius, and it was not a great year for Sirius XM writ large. They were down in total usership across Pandora and their satellite business. However, despite the fact that their revenues were down year on year, their net income was up, and Sirius generated $1.2 billion in net income last year, as opposed to Spotify, who generated $500 million in losses. And yet Spotify stock is up 105% and Sirius's is down 13%. This is something I don't necessarily understand. I get why there's doubts around this business, but I don't understand why there's not doubts around the other. Amazon, on the other hand, is a business worth keeping on board with. After a really rough 2022 and a kind of really difficult transition from their founder to the first CEO post-founder, where they lost almost $3 billion last year, almost entirely around their core business of e-commerce. Fourth quarter, they had amazing numbers. Full year, amazing numbers. The big story here is their advertising business, which is now the fastest growing on the face of the earth. It's almost entirely, it'll be about $40 billion this year. They probably did around 39 billion last year. This year and last, most of that is retail media. But as I think a lot of you know, that just this month, they started opening their advertising business to their entire video ecosystem, including Prime. They were always doing ads on Freevee, but now it's a much larger television operation, which comes on the heels of turning Black Friday, Thursday Night Football into a shopping ad palooza. Which was really impressive and really kind of changed the way the ad business is going to head over the next number of years. E-commerce bounced back in a big way. Their AWS business is slowing from a growth curve standpoint, from a historical standpoint, but they were such an early mover here. They're not really being punished by that. Crucially, that you can see, kind of like a lot of big tech, they've morphed from a products business into a services businesses. And as a result of a huge infrastructure, including an ad tech that is second to very few on the planet Earth, their revenues were up and their overall revenues were up, but driven by a big growth in services. And their net income, obviously, again, it's easier to be taller than a small glass of milk. But because they lost $3 billion in 2022, but it's a really impressive turnaround. And this is a company that I think is going to have an amazing 2024, despite some regulatory issues that they too are going to face over the course of the year. And they're near, I think they're at their all-time market valuation, which is really both impressive and incredible. But they actually have now fallen behind NVIDIA in total market capitalization. Just a quick side note there. On the other end of the Death Star hallway, you've got Apple, who had a pretty good fourth quarter. Net income up 13%. Revenue's up 2%, which may seem small for Apple, but relative to their recent performance, not a terrible story. Their services revenue was up dramatically in fourth quarter, driven by almost an indescribable array of products across gaming and television and news and their massive revenues from taxes in the App Store. However, their product sales are flat. All other products other than the iPhone were down year on year, and the iPhone sales have slowed dramatically. And what's also not present on this slide is they are losing a battle over app taxes, where Epic and other third-party app developers are going to take their payment system outside of the App Store, both in the App Store and in Google Play. So that's a threat to that revenue line. And then when you look at the full year, and this is the year that ended September 30th, not December 31st, but still just 90 days out from the end of the year, you can see services is the only really good story here. Their revenue sales were down 5.7%. Their product sales were down 5.7%. Their overall revenues down 2.8%, and their net income down 2.8%. This is not the story that Tim Cook has been telling for some time, and it's very explanatory for their current strategy, which is to go all in on services, to invest heavily in the app ecosystem, but heavily in both advertising and a number of other areas in the services sector. It's going to be an interesting year for Apple, a transitional year for Apple, and yet still they're not being punished from an overall market capitalization standpoint. They're down from the year to date, but they're up historically for their overall valuation. They're no longer the most valuable company on the face of the earth. And it's going to be interesting for the first time since I've been tracking them through my various ecosystems. They have become a company in transition. On the other hand, you've got Microsoft, who is now the most valuable company on the face of the earth. And you can see their diversified revenue flywheel is in much better shape than Apple's at the current moment. Their net income was up dramatically. Their more computing business, which includes gaming, and this is just fourth quarter, and their productivity and Office suite of subscription services is up pretty dramatically. And they have a pretty fast-growing cloud business. However, for the year, it's a little bit of a different story. Their productivity growth is slowing from a historical basis, and this is the year that ended June, by the way, not the year that ended December. So fourth quarter may be a better gauge of where Microsoft is at than this is. However, for the year that ended June 30th, their gaming division was really not doing as well as it should be. Their Windows businesses and devices businesses are down dramatically. Office and LinkedIn slowed to a certain extent. Their revenues are up, but not at the trajectory you're used to for Microsoft, and their net income was actually down year on year. So it's interesting to look at this company who is now at an all-time high market valuation, or actually they were up a little higher a couple of weeks ago, but of more than $3 trillion, and say, hey, they have some work to do. But that's actually true. They just finished acquiring finally Activision, and that transition is going to be massive and painful. They just laid off 1,900 folks at that division. And that's just the start of the pain there. Activision was in a real troubled position before they started getting acquired by Microsoft, which is one of the reasons why they got acquired by Microsoft. Their toxic work environment and threats of many lawsuits. So the integration of these two major companies, which, by the way, on the average out in the business ecosystem fails more times than not, is going to distract them all year long. And if they don't necessarily figure out how to come out of third place in gaming, which is where they still are to Nintendo and Sony, they may not have the growth in the other areas to make up for such a expensive and interesting business as gaming might turn out to be. That said, I do love the diversification of this revenue flywheel, and I think this is a company that's incredibly well run. So if they can get past that integration, I think they're going to be in really good shape. Sony is a great company. I love tracking them because their valuation never goes up too much or down too much. It always stays within a certain window of value. However, this slide and the next one really demonstrate why they need to spin off their non-PlayStation electronics division. It is holding them back as a company, I think, from an innovation flywheel standpoint, but also from an overall valuation standpoint. Their net income is down over 9% because their electronics division is down 3%. Yes, film and television didn't have as good a year last year as it should, but it had a really good fourth quarter. The problem is their old school electronics business and their addiction to it. I think Sony's going to get into the buying game. I think there's a major competition with Microsoft that they need to keep up with. And I think there's a ton of companies out in the ecosystem in the gaming sphere that Sony might acquire in 2024. I do think I think they're ripe for a major move because I do think now more than ever with the Activision acquisition, they feel a threat. Their market cap is down 5% year on year, but it's still in its relative $100 to $120 billion valuation window. On the other end, EA had a really good fourth quarter and then a kind of meh year. Their live game business is growing pretty well, but their full game business is not really going to make it long term. This is a business that is declining year on year for the last couple of years, and their revenues are up, but their net income's basically flat. And that's because these games cost so much and take so long to develop. It's hard to cut overhead in order to get to a net income number that you like. That said, their market valuation is up 27%. I do think this company, as with a lot of indie gamers, faces a lot of headwinds over the next number of years from the major players in the ecosystem. And I do think there's going to be consolidation in the space. Nintendo had a great year in 2023. Their operating profit in fourth quarter was up a lot. Net sales were down. That's a bit of a year-on-year comparison. For the year, their net sales were up pretty high, and their operating profit was up. Now, this is an off-cycle year for them. They didn't launch a new console in 2023, and yet their operating profit and net sales went up last year, and they're going to overperform on total console sales by 500,000, 15.5 million, they say, now by the end of their fiscal year, which isn't until March. By the way, you can see this is just the first, the April through December of last year, which is the first 9 months of their fiscal year, which ends in March. Their market capitalization is now up as high as I remember it, $77 billion. But they're just 1 year away from a really shitty year. The reason they had such a good 2023 out of cycle was because the Mario Brothers movie, which has done $1.5 billion in box office worldwide, was the greatest marketing tool their game platforms ever had, both in games and in consoles. And so they sold more consoles and games last year than they anticipated and outperformed all their projections. I don't think you can count on that to happen every time out of the box. I also don't think you can necessarily affect the strategy that their CEO spoke during their earnings call, which is to sell multiple consoles per home. I think this is a specialized product that takes about 10% of the overall gaming ecosystem, which is not a lot. And I think the really lousy 22-23 that they have is really just one bad gaming cycle or one bad movie launch away from happening, which is why I think Nintendo is also a buyer in the gaming ecosystem in 2024 and 25. And I think there's a lot of small gaming companies that are ripe for acquisition. I think there's a major one that they should acquire, and that's Roblox. Roblox is a very successful platform. Their MAUs, their total usage is up. They're a massive platform for people under the age of 25 worldwide, but they've never been profitable, and they're losing more money now than they have in the past. I, at one point, thought that Disney should buy them. Disney instead invested in Epic and Fortnite, which I thought was a pretty smart move relative to the whole, because they only had to spend $1.5 billion versus $20 or $30 billion to buy Roblox. But I don't think Roblox in an ecosystem with Tencent and Microsoft and Sony and Nintendo can survive as a standalone business while they're losing billions of dollars year on year. I think there's a tremendous amount of upside here, most notably from advertising, but I also think Nintendo's IP in this ecosystem would be amazing. Right now, you can't play Roblox on Switch. Imagine the increase in sales of Switches if you could. So I do think there's a major opportunity here, either for Sony or for Nintendo. I hope one of them takes it soon. Roblox actually had a pretty good year relative to their own historical record, and their market cap is up. Disney is an interesting story of contrasts here. You can see operating income, segment by segment, was it a good story for Disney in fourth quarter. This is in large part due to massive and kind of really fucking painful cuts that Bob Iger did all year, right? What he talked about in earnings call after earnings call. But what you can see here is that unlike some other players in the media apocalypse, Disney has been able to turn those cuts into operating income growth, massive operating income growth in some segments, especially in sports and direct-to-consumer streaming. What's interesting to see is this also played out all year long. So their operating income in fourth quarter was up 27%, but their operating income in fiscal year 23, which granted was the quarter that the year that ended September 30th, but still an even better grade of their overall health, operating income was up. Revenue's up as well. So Disney's been able to cut while growing revenues and operating income. Not everybody in their peer group has been able to do that. You top that with the epic $1.5 billion investment and Spulu, the sports bundle that they announced. And it feels like Iger may be getting a handle on the navigation system of this new Disney. We'll see. It's going to be a really interesting year for them across the board. And one of the most notable generators of their income, the Marvel franchise, is in real trouble, as is the Star Wars franchise, except if you look at their television shows. But in film, this is not a franchise that is where it should be. And by the way, I don't think there was one commercial for the Marvel franchise during the Super Bowl, the first time I can remember for a decade, that being the fact. So Iger looks to have a better handle on things, but it still remains to be seen whether his cut to grow strategy is going to work long term. That said, Disney's market cap is up 23% just this year, so the street seems to like where he's headed. Fox is a disaster. Meta, on the other hand, is an absolute, year-on-year champ. Now, this is the classic study of year-on-year comparisons. Meta's 2022 was a dumpster fire, a disaster area and a dumpster fire, a disaster fire. So by comparison, it's not hard to look good. That said, I think it's really interesting to watch. Just checking on the chat here because I thought I'm hoping we're not over time, but I'm going to keep going on. Their net income was up a dramatic 200% in fourth quarter, and a really healthy 70% for the total year. This says three things. One, they had a really shitty year to compare to. Two, they were able to make cuts without cutting to the core of their revenue generation. And three, this is an ad business that is really back. The digital return on ad spend, ad buy is really bouncing back. And you can see this across the board, especially with the next couple of comparisons. So, those three things are all true. The one thing that Meta has to worry about is they are a 99% ad business. So in the next ad downturn, Meta is going to have a very difficult time, just like they did the last time. And so this business is not yet protected. As much as they like to talk about the metaverse and AI now, this is an ad sales company. It's a privacy sales company, but it's an ad sales company primarily by revenue model. But they are at I think an all-time high market valuation, up 175% year on year. Again, it's a point of comparison, but still, this is a company that is flying high in market cap. On the other hand, you see Snap actually upped revenues and net income in fourth quarter pretty dramatically in net income, which is a combination of the digital ad economy coming back and them also making cuts and turning it into operating income or net income. However, Street didn't like it enough, and that's because the revenues for the full year are not up here, and this is going to be a very tough business against the big tech Death Stars for any digital platform, including TikTok, by the way, who doesn't do earnings reports the way that we do. So this stock has been punished just year to date down 30%, as have other players in the digital space. On the other end of the scale, and really the true sign of where the ad economy is going, Trade Desk is absolutely on fire right now. Net income in fourth quarter up 37%, revenues up 23%. This is a company that invested heavily in the evolution of advanced audiences and advanced advertising, and it's really paying off for them. They also invested heavily in retail media, and so everywhere the ball is going, Trade Desk is standing already. They are heavily playing in the retail ad economy in a way that few companies outside of Amazon are, and Walmart maybe. And they're really cutting the course of how the new economy is going to be played. They're at the center of more deals than I think a lot of people are necessarily comfortable with. But at the other hand, there's not necessarily that much choice out there with regards to the power of this platform. They had a great 2023. They're going to have an amazing 2024 because they are where the ad economy is going, Trade Desk. It is going towards business outcomes and return on ad spend versus massive brand campaigns where half the money may be wasted. You just don't know which half. It is going towards a data-led ad economy where the first-party data commingling and processing upfront will be just as important as the reporting on the back end because they are directly tied to each other. And so this company is at the heart of where the ad economy is going. I think you'll see these trends continue to play out and amplify in the new front and upfront in the year ahead. And Trade Desk's market cap is now 26% just year to date, and they just reported a couple days ago. So that's my report for the first quarter earnings season. Keep an eye on this ecosystem as it changes. Most notably, keep an eye on the trajectory of companies like NVIDIA, which is now the third most valuable company on this map. And the combination of Reliance and Disney's ownership on Hotstar is something to track here. The emergence of the sports bundle is something to keep an eye on here. But overall, I think if you read the earnings reports of these companies quarter on quarter, you will never be taken by surprise. That's the big lesson here. So that's my report. Almost exactly 45 minutes to the T. Did not have a timer present. So I'm going to welcome to the stage all of my co-captains of the next conversation. John Giegengack from Hub Entertainment Research, Ophelie Boucaud from Dataxis, Alan Wolk, the TVREV, and Paul Erickson of Erickson Strategies. Thanks, guys. I'm going to take a sip of water. I'm just interested in your reaction, feedback, questions, and commentary.
Can I just say I was amazed that you kept that to pretty much exactly 45 minutes. That's
very good pacing. Yep.
Yeah, impressive.
I don't think I breathed once.
I didn't see it at least.
Yeah. Plus, like comparing things to a poodle now. That's going to be my go-to phrase. Bigger than a poodle.
I had to keep coming up with things to be taller than.
Yeah.
Do you want to take questions from the Q&A?
Sure.
Hi, it was mentioned that many others are following Netflix into paid sharing as it showed great success for Netflix. Do you know who else are going in the same way? I'm going to toss this to Alan, who is, to me, all things streaming, or John, who tracks this subscription stuff pretty well. But I know Disney started to crack down.
Yeah, they're all kind of sort of doing it and kind of not. Like no one's ever, like, the thing is, like, they'll send emails here and there. They'll ask you to re-authenticate, but they're not like the rubber is really going to hit the road when they start telling people like, no more TV for you if you don't get a new account. And they haven't really done that yet. They've sort of been relying on threatening emails. And they all test it out in other places, but no one, not even Netflix, has sort of rolled it out all across the board.
And I think the smaller platforms than Netflix, so basically all of them have a lot more to lose than Netflix does by rolling that out, because Netflix has sort of replaced, the old cable TV as kind of the default thing that people watch. There's something on there for everybody. But I think if it's something that's more of a niche, are you gonna are you going to be willing to pay extra just to keep getting Paramount Plus because you really want to watch the Taylor Sheridan shows while they're still on, for instance? I think that without that kind of scale that Netflix has, the potential downside of calling people's bluff and making them sign up for their own account is not as there's more at risk for those other platforms than Netflix, which I think they still need to do it. I think what would be a smarter thing maybe for a lot of these companies, a way to generate more revenue would be to do like what Disney Plus did when they launched and give you a deal on the price if you subscribe for a certain amount of time. I think that might be a better route for some of these platforms than really cracking down hard on password sharing.
Yeah.
But doesn't it seem to have worked incredibly well for Netflix? I mean, am I missing
Netflix
something?
did, yeah.
I mean, it's worked okay for again. Like there's a lot more. They have a lot more runway there. What we're going to see happen, which is going to be really interesting, is they're all going to raise the price of the ad-free version vis-a-vis the ad-supported. That's just sort of common sense because most people, think of the use case, right? There's a show I want to watch. I go to subscribe. So for $5 or $8 more a month, I can watch it without ads. Well, that's sort of a no-brainer. But what if it was $18? What if it was $28 more a month? Then suddenly I'm not going, and they all need to push people to their ad-supported because they all got blindsided by Amazon, who basically came in and said, yeah, everybody's ad-supported now. And suddenly, and we're estimating that somewhere between 50 to 65 million people. So they've got to catch up.
But so outside of Netflix, the churnpocalypse is really the existential crisis. And John, you write about this a lot. Paul, I know you study this stuff a lot. Ophelie, I don't know how much you bundling you cover in your market, although I imagine a decent amount. But it does seem to be the conversation of the moment to protect all of these players. There are interesting bundles, and then there are less interesting bundles. There's a kind of bundle amongst frenemies, right? The streamers themselves. But then you look at the Verizon bundle with Netflix and Max, and that feels, and John, I know you've looked at this deeply, feels like a pathway that might be, that's more like the triple play that I talked about a little earlier, and feels like a more protective shell than just a bunch of video services ganging up together.
There's something. Sorry, Paul, you want to start?
Oh, sorry. Yeah, I might as well. I think, Evan, that's a good point. You look at the way forward for a lot of the traditional service providers, and I don't know if this is going to be a very popular opinion, but I think, we see that a lot of the core businesses there are not the strongholds they thought they were, right? Like broadband is now threatened by 5G home broadband and a number of other pressures. And so as they look to, I personally think that they should look at themselves as more than simply a provider of cable TV, a provider of broadband, and maybe somebody that also throws in an MVNO delivered mobile service, right? Look at that beyond that bundle. And if you think of a greater idea, like they provide connectivity, they provide convenience, right? And part of that, if you think of delivering that big picture value, is that maybe billing and subscription aggregation with a little bit of rev share, right, is a way in which they're a conduit, right? They don't have to deliver you TV. They're just your gateway to consuming whatever you want. They happen to also maybe provide the broadband connection over which you consume all that stuff, but they're happy to let you have one bill, one consolidated relationship, because people were having overload of not just content.
But that was the success of the bundle, the triple play bundle originally. It is the great success of Amazon Prime.
Yes.
And I think that's to your point. I think I believe that's going to be the table stakes for most of the players, the platforms. You can be a publisher and sell wholesale into these platforms, but I think we're going back to a very, these Death Stars are going to form the new set of whatever you call MVPDs, except they're going to be big tech hubs versus kind of home hubs. Ophelie, you were going to say something.
I wanted to jump also. I think there's an interesting connection to make with the ad tiers actually, because the ad tier is bringing the price down of all of those OTT platforms, and that's actually something that the telcos are working on. For partnership opportunities, it's much better because then it gives them a price point that's way more sustainable to create huge bundles, and we see that a lot more, I think, this year, and probably we'll see it also in 2024. For example, we've had in France an offer from MyCanal, which was really like discounted AF during Christmas time. I think it was like 25 euros to get Netflix, Disney Plus, DAZN.
With your
I'm not sure
mobile,
if Prime
Yeah.
was. No, on the TV.
on
So
TV.
including Canal as well, which is the premium entertainment hub. So I think the promotion was like 6 months, but still the price is really, really low for such a huge amount of things. And that's only because they can sort of gain traction from the ad tier and take down the prices thanks to that. So that's quite interesting.
Yeah, I mean, the other thing is they don't make money off of the pay TV. Like that's just
Mhm.
they used to at one point. It's just a stickiness thing. So they could give a flying bleep whether they're showing you the traditional pay TV bundle or a bundle of streaming services. It's all the same to them. And we saw that with Charter, where Charter was like, "Yeah, Disney, you want to play ball? You're going to give us a discount so we can pass
But
that."
they
on."
did. I
That's
mean,
sort of the
they
start.
shed a decent number of subscribers, I think, above the norm as a result of that, and they're not going to come back.
Yeah.
And then you look at the broadband, flattening out in the U.S. And my question for all of you is, Zumo or not Zumo? Do you feel like they have because constructed correctly? Zumo should be between these two companies. You're talking about 60 million broadband homes in the United States, the most valuable consumer homes probably on the planet Earth, right? And in all main markets, and you're talking about broadband in a main market. So these are expensive customers. It does feel like they have an opportunity to bundle a television set with a suite of services, mobile, broadband, all these video services at discounts, everything you want and don't want, home security together. That feels like a competitive advantage that very few people other than an Amazon Prime have in the US right now.
We've done, well, and Evan and Alan, you guys have seen it, but we've done a lot of research on bundling, and there's two things that are kind of creating a ceiling for how many different not just forms of media, but how many different subscriptions people have. One of them is cost, but the other one, which is just as big, is just their ability to use it all. So complexity. There's just as many people who say, I don't add another streaming subscription because I can't afford it. There's just as many people who say I don't add one because I just wouldn't be able to use it, or it's too complicated to manage all these individual relationships.
Right.
So I think what both of you guys have just said is exactly right, that the pay TV companies have this huge opportunity to aggregate together lots of different things like the triple play, but there's no reason to stop at 3 anymore. And they could aggregate together your gaming with cloud gaming, which some of them are already doing.
Right.
They
It comes
could
comes
plug
through
in
the
your
same set of pipes, right?
yeah. And people assign tremendous value. Like if you look at Verizon Plus Play, which has been pretty successful, that there isn't actually any content at all associated with that. All they're doing is they are making it easier for you to use all the subscriptions that you already have, and one place that you can go and shop for them, and one place that you can add them or drop them. And just that process of simplification is valuable enough that in our surveys, there's a lot of people who say that they would be willing to pay for something like that, even though it doesn't come with any content itself. So I think that that's a whole
The aggregation
sort of side of the Rubik's Cube that gets overlooked, which is that just adding more content, the amount of value that more content adds starts to go down, and maybe even starts to decline. We did one survey where there were people that said that they would pay more for a smaller bundle of TV networks if it was just the networks that they use. So if you just I'd pay extra
Well, and so
to have
so
25 instead of 100 because it would only be the 25 I care about.
yeah, but it's the difference between the price fee and the fee fee and the a la carte. Yes, you're going to pay more for each individual steak that you buy. I want to jump into this question from the comments from Brandon. Which company is best positioned to fully leverage the massively expensive sports rights leagues relationships right now? I think as I've become a dead horse at one point, at some point, but you know, I think big tech is the only suite of companies that's going to be able to possibly afford the crazy prices necessary to purchase the best sports rights out there. So the NFL, IPL, Premier League, you know, those types of companies. Reliance is the owner of the streaming rights of cricket in India. Disney is now the owner of a massive set of rights. But if you look at where the puck is going in the US, YouTube and Amazon seem to have a better position on where it's going than ESPN might. So I'm going to toss this out there. Same question to y'all, but also on the back end of that, does Spulu, the sports bundle, or Disco Balls, depending on what you want to call it, in context of all of this, so who can best take advantage of sports rights? And in context of your answer, does Spulu work or does Disco Balls fall flat?
I guess I'll jump in first. I got in there first before you, Alan, but I'll be short. I think I'd agree, you know, and I think it's been a long-standing problem for services where there's been a continual rise in the cost of content, especially the highest value content, which tends to be sports. And you know, we see we're already from what Amazon has done with the NFL, you know, what Google's done, and you know what they're willing to do with YouTube TV. And I think that it's only going to accelerate the inflation of prices when it comes to live sports. And in the end, you know, how are they able to afford it? Well, you know, the nature of their businesses, they're able to absorb it in their very diversified businesses, right? They can absorb that massive cost and make it work. And it may be, you know, financials that other pure play streaming services simply can't work. So something like a Spulu or Disco Balls maybe one of the only ways that collectively you can get enough bargaining power to really be able to go up against, you know, these massive tech giants and hypothetically amass, you know, not piecemeal these massive big picture deals, but enough mass of sports content that's diversified where it's not, you know, two big leagues. It's actually a lot of coverage. And that may be a good value proposition for people who really love sports. They want just one reliable source where they can watch a lot of content or maybe all of their.
Well, what are they going to have to charge to the individual consumer? I think I saw $40.
Wall Street Journal said $50.
Do I hear 60? Do I hear 70? I mean,
I think it might be
without the
less than that,
NFL, without the NFL, without Premier League.
I mean,
30, maybe 50. 50's high in this environment, I think.
Yeah, but how does it work economically otherwise?
I don't know.
Yeah,
I think the other. Sorry, Alan, you're going to say what I was going to say, so you go first.
Okay, so two things. If I'm the NBA or the NFL, I'm looking around and going, okay, you know, Alphabet, Amazon, they're gonna be around in 2-3 years. Like, I have no, you know, confidence that any of these other companies are going to be around in 2 or 3 years. They're not going to get bought by someone else. They're not going to be merged. So why wouldn't I go with them, right? And as for Spulu, like, say it's $40 or $50, which is what the Wall Street Journal, you know, and I believe Jessica Tunkel, she's pretty on spot there. Like, for $72, I can get YouTube TV. So why the fuck would I go and spend like a little bit less money and not get CBS and NBC? Like, I can get all the sports I want in one place for a few dollars more.
Yeah, but for the broadcasters or for the cable companies, and this is as true in Europe as it is and throughout the rest of the world as it is in the US. You know, these rights aren't profitable. There's just no way to make them profitable. I don't care how many subscribers you sign up for a day, Peacock. It's going to be hard to justify $100 million per game.
Well, yeah. So let's
but wait. Let me ask Ophelie.
Let me just before you explain why it's not profitable, because that's really important.
Well, because they're paying so much per minute of content.
Because they used to have to force people to take their packages when it was all on cable.
Now that fee is disappearing on a regular basis. So Fox can't rely on their retransmission consent to the level that they could to help pay for that football deal. But in Europe, you have this interesting system where a lot of the major sports, so FIFA is guaranteed to be on a public service media. It's the biggest football match of the world every 4 years, and everybody gets to watch it for free, right?
Yes, but then you also have a lot of premium sports that are very expensive and that used to be bought by the big pay TV names in Europe. So
But are
you
now
had
being
Sky,
bought by.
Canal Plus.
But now,
Yeah,
who's going to be buying those now? Do you think?
DAZN mostly. I mean,
What's the DAZN's strategy? It feels like an exit strategy, kind of expressly to me.
so actually, they published recently their 2022 annual report. They're kind of late, but I guess that's that's whatever. And yeah, they're reducing their debt, so they're still $1 billion in debt. But I mean, as of 2022, so maybe it got better last year.
But they invested
we
in a
don't
lot
know.
of sports rights over that time, and then
Yeah, they did, but they have a very interesting strategy because they're an OTT platform. They can afford to do stuff that not many other pay TV cable cos could do before, which is investing a lot in betting, in additional interactive features and merchandising. So they can actually push revenue-driven features way better than the others used to do because they were mostly relying on broadcasting for generating revenues. So it might be that they're actually heading for profitability not so far off from now. I think they mentioned even 2024. I'm not sure that that's going to happen, but they're quite optimistic. So it's actually not too bad.
But even in your region, the regions that you cover, to a certain extent, sports rights are traditionally, not always. I mean, there are the pure play cable companies, right, or television companies, but very often they're bundled by a mobile carrier, correct? Or am I
By telcos, they used to be, yeah, but less and less now. So Amazon Prime entered in France, and DAZN has the rights in most markets except for France now, but the tender is still pending for the domestic championship in soccer. And the thing is, yeah, I mean, in Europe, outside of soccer, not much costs a lot, let's say. So that's what drives the...
Ophelie, do they make less money on advertising, Ophelie, on on soccer? Because there's not like in American football, basketball, there's just so many breaks. They can run so many commercials. Soccer is a very different game. So do they make less money that way?
Yeah, they make way less money. I don't know how it works exactly for media sales in the US, specifically to the big games, but in Europe, we still have a very, very strong regulation across the different markets when it comes to advertising sales. So you're limited in how much ad breaks you can put. And even if obviously the prices go up during big games, it's nowhere comparable to what's going on with the NFL, like nowhere.
Yeah,
But advertising is still big, I guess. But a lot historically has been driven also by subscription with premium sport packages for broadcasting major games.
But across both ecosystems, North America and Europe, and into MENA as well, the number one competitor I feel amongst television companies is not each other; it's YouTube.
I would say also for sports piracy in some markets, actually. But yeah.
Well, there is that aspect of it. But by my estimates, whatever region I look at, I'll pick a country. If you take all the various forms, so I mentioned this during the keynote, YouTube Premium is now over 100 million worldwide subscribers. Quietly got there, right? While no one was paying attention. Really, right under Disney and Netflix for total worldwide subs. You add to that YouTube Kids, YouTube Music, and all these other services. And by my estimation, in almost every territory I've looked at, YouTube's combined reach is much bigger than any other channel on connected television.
Yeah. And when you ask, I think any kind of CTV manufacturers, they will tell you like people are only watching 2 apps, Netflix, YouTube, and maybe sometimes the rest. I guess in the US, it's more spread out across the other players because they actually have a strong presence. But in Europe, it's still the main 2 players, and the rest is way below.
And then when you go under the age of 15, there are no other players in the set, maybe Disney Plus or something like that. And so you have, you know, 2 generations under the age of 20 right now, growing up, you know, really logging onto this to watch YouTube and Netflix. And it's kind of interesting to watch Paramount and Fox and Disney, or, you know, really even, you know, the other commercial and public service broadcasters battle amongst each other, as opposed to pointing, you know, gathering together and pointing against, you know, these massive big tech death stars. Because it's not really just Google, it's and Netflix, but it's also Amazon. Prime is a major platform, and Fire is a massive television platform around the world. Then you think about 60% of the ad economy taken up in the US by just 3 companies, Amazon, Meta, and Google. And I wonder, how does traditional media not think about, forget merging for a second, just coming together as an ad ecosystem?
Yeah. I think
as a counterbalance to the big three. The buyers don't want to buy the big three. They really don't. They would prefer not to buy the big three. And by the way, they're proud to say it. But on price and reach and effectiveness and measurability and data and all these other aspects, it's really hard to not buy them at the end of the day and affect the things you need to do for your business. Why doesn't the ad ecosystem, the general rest of world understand? I mean, this is like the Independence Day threat. Here they come. Why why don't the rest of them gather their data ecosystems together and create a wall, you know, a data ecosystem that can compete with the big tech death stars?
I
I
can
throw that
mention
open to the field.
a few cases for Europe, for example. If you talk about collaboration, the broadcaster. So usually in each European market, you would have 3 big broadcasters, 2 commercial ones, 1 publicly funded, and they are the ones fighting each other historically for TV market share and now for BVOD platforms. The problems that they have is that the regulation in Europe is so tough on TV that they can't really merge together, which is why TF1 and M6 couldn't merge in France. It's also why it's difficult to actually collaborate, because they don't have the same expectations when it comes to commercial goals. For example, in Spain, I think 5 years ago, there was a common app launched on CTV by the 3 main broadcasters, but it stayed at the point of just sort of like a TV everywhere service where everyone puts content together, but free to air content only, because they can't really figure out a common strategy to monetize together. They don't want to give access to their own data to their main competitor still on their domestic market.
Yeah, I think the relationships between the public service broadcasters and the governments that govern them is, I mean, the media bill is about to be redone in the UK, and I do think that there's some happy byproducts that are going to come out from that. Freely was just announced as a collaborative platform.
Exactly. Yeah, that's a good example, but it's still wondering like where it's going to go, because if you consider the TV market share, so it's usually spread like 20 to 30% for each of those big commercial broadcasters. And then you look at the digital ad markets, and you basically have Meta and Google, and that's it. And they take like 90% of the digital ad market in every country, I mean, outside of China or Russia, but mainly. And no one really seems to bother about that. So like the competition regulation only works for the TV world, doesn't work for the digital world. But
Well,
yeah,
we'll see. I mean, there's going to be some shifts, I think, because of court findings. Maybe not necessarily regulators, but Google and Meta are going to lose a pretty substantial case in court here in the US that's going to change. It's already changed the way they do business. I think there's more likely than not that Google's going to find itself being somehow regulated out of the absolute monopoly they have in search at some point. We'll see. We'll see. Or maybe they're going to get out innovated by Microsoft and Bing,
Maybe.
who now has a massive 3% search market share. But is there a true bulwark to the big tech death stars, Meta, Amazon, and Google, in the ad economy right now? I mean, is there an outlet you see effectively counterselling to that group?
No, because they don't trust each other. That's the problem.
Yeah.
None of the media companies trust each other enough to work together. And I mean, they can't even figure out how to measure things, right? Like in the US, like they're still thinking around about, is it Nielsen? Is it iSpot? You know, like instead of just going, and making them all jump through hoops. And meanwhile, all the tech companies are going, this is how many people watch. We know exactly, and you have to believe us. And so, it's that it all goes back to like they all thought they'd be the new Netflix instead of just like working with the the MVPDs, and if they would just kind of all exactly, we always the line we always use is the Benjamin Franklin quote. We all need to hang together, or we shall all hang separately, and they need to remember that.
It's almost like they're sort of gradually capitulating to that idea. But if you look at the sports bundle, for instance, just the fact that those three companies came together to make one is a change in
They didn't make anything.
philosophy.
That was a press release for Bob Iger's earnings call, expressly, as the NFL and other leagues have said since.
But
we didn't get the call. We had no idea it was happening.
Like even if you take it at face value and take it as being as genuine, by depending on what optimistically, you're still missing about 30% of all the sports content that's out there if you don't have NBC and you don't have CBS.
Right.
And something that has 60 or 70% of all the sports is not 60 or 70% is valuable to consumers. It's 0% is valuable to most people. And it reminds me a lot of, because I think that if we look at what happens in TV, you can see it mirror things that happen in other media, like music, for instance, going back to before, so kind of post Napster and Morpheus and pre-iTunes, the 5 big music labels that there were at the time, 3 of them came together and made their own online music store. The other 2 came together and made their own online music store. And I did work for one of those companies back when this was happening, but they all thought they had this cracked. We're all going to have the music online. But it turns out if you're a music fan and you go in there, you don't know who publishes your favorite artist. But if you can't find 40% of the music you like, it's a complete non-starter. And then Apple was the first one to sign licensing with all those music labels at once. And that really kind of started their rise to where they are today. But I think we're seeing, as Alan said, they don't trust each other, or more than that, they all are still kind of hanging on to this idea that like, I'm going to be the next Netflix. We have to sort of guard our brand and not collaborate too much. But I think that I agree that they would be better if they all just kind of turned 180 and headed in the opposite direction as fast as they can.
And there's a few things like OpenAP is trying to do, is trying to get them to all sort of row in the same direction, but they need to do harder. But back to Spulu for a second, like, who do they think the audience is too? Like, anybody who's a big enough sports fan that they're going to pay $30, $40 a month.
Total amount of strategy
already has a pay TV subscription.
Who's writing the press release and what font should we use? Like,
seriously, Evan, like anybody who cares about sports that much is not cutting the cord. Like, they're like, yes, I'll keep my cable subscription.
There's a good chance they won't regulatorily be able to that. They're not gonna. So, like, the lack of planning here is impressive, even by their own standards.
Do you think it occurred to me that maybe they were looking at it as kind of getting a foot in the door, so when everything eventually,
or in their mouth,
so that they have some kind of a platform built or something,
but they didn't do the homework. I mean, it was like Keelar announcing, he was moving all the movies to Max before telling any of the talent that he was moving all their movies to Max. Yeah. But in this case, they may actually have the rights. Like, they haven't talked to their rights partners about this.
There is that.
It's also kind of like Netflix deciding to insert ads into everything and not really having the rights to insert ads into everything, and everybody calling them saying, no, you don't. And really quickly, I want to test out a thesis here. By the way, to answer 2 people's questions around Fox. Fox is just a dumpster fire. Read the earnings report. It's just their one cash cow, Fox News, is facing its second $1 billion lawsuit loss. And all the revenues across the entire enterprise are just either flat or going down. Tubi's the only good story there. But I want to test this thesis I had a little earlier, which I'm not 100% convinced in myself, which is Iger is back. It did, the Spulu announcement, as chaotic as it was kind of a stroke of genius, as we're all demonstrating here. And then secondarily, the Epic investment was epic. I thought that was a really smart fucking move. I think it will pay dividends for them. I've been trying to push them into gaming from afar for years. But the rest of the enterprise, other than the old school television stuff, even the spinning out of ESPN seems to begin to make a little bit more sense in context of this. Am I missing something, or is he like, has he found, did he get his groove back?
I think that was a huge game changer, that they recognized the value of getting into Epic and into Fortnite, because it's gaming, but that's sort of the scratching the surface of what it is. It's a community. That kind of creates its own content. It's a live service game that people don't need to go out, but there's no kind of retail component to it. And it can be, I think to be really successful now, I think companies have to have three things. They have to have scale, they have to have diversification, and they have to have IP. And I think with Disney, they already sort of got diversification with parks and with movies. They have their own games division, but they haven't really been able to make as much as they could out of that. But if you take all of that IP and you plug that in to with Epic, with Fortnite, with a company that really knows how to do it, I think that is the sky's the limit. I think is how far they could kind of push that.
Crucially, the difference between where they've been and what this represents is they're going from game making into the platform business. They're building a world on a platform versus just issuing games that can be replaced. So that to me speaks,
it's kind of like Club Penguin, but done.
Yeah, but I equate it to buying marshland in South Florida and calling it Disney World.
Well, yeah, it is actually kind of like that.
I really do think there's a parallel there, and I think it's a smart one. And Iger takes a minute to get to the right destination, but he does often get there. And crucially, it feels like the deal making mojo which is how he made his bones. Marvel, Star Wars, I can go down Pixar. Winnie the Pooh. He's got the deal making, cred, and this feels to be more building as opposed to taking away. I think that's the major difference there. Ophelie, I'm interested in your perspective from afar with regards to a U.S. company.
I don't watch Fox so much, but no, I think the gaming position is actually interesting, and we see a lot more company also getting into it. Amazon launched Luna, I think 2 years ago. Netflix is also investing in gaming. For now, it's still kind of shy because it's focusing on mobile. I'm not sure where it's gonna go, but it seems like they're all dipping their toes in there. I don't think they all will secure a good spot though.
Sorry. I was just going to say one interesting thing about Netflix and gaming. So Ophelie's exactly right that so far they've sort of been dipping their toes in the water with the mobile games, but they've been hiring people for a while from AAA gaming studios.
Yeah.
And the most recent thing they did is they licensed all of the old Grand Theft Auto games. So now you can play the games that were originally on PS2. You can play them on your phone or your tablet, right as the new Grand Theft Auto is getting ready to come out. I think that's a huge. It's the same thing. It's that kind of diversification and IP. They bought the IP that everybody notices, even if it's the old games. And if they really start to grow that, I think Alan and I had talked about this the other day, but just if it's all about time spent, all about engagement, video TV is just one thing that people spend time on. And young people, it's something that they spend relatively little time on, but they spend a lot of time on gaming. And if you take your IP like Stranger Things and roll that out into gaming, there's opportunity for that. Or if you buy your way into or associate yourself with, real destination IP like Grand Theft Auto, that's another way that I think they can very quickly make themselves the center of gravity for a lot more of entertainment behavior, not just TV and movies.
Yeah,
to capture more time. Capture more attention.
Yeah. Go ahead, Paul.
You're right, John, in that I think that they're looking at how they broaden their perspective of being a high engagement entertainment provision service, right? And I think, what we see so far, I think, cloud gaming on the big console style, console quality gaming has had only modest inroads, right? But I think if you look at what they're doing right now, they're starting with looking at consumption behavior of apps, right? You downloading the app and installing it. But the thing is, when you deliver a mobile cloud gaming experience, if you're familiar with Blacknut and some of the others that have been out there, that takes way less resources and bandwidth than delivering a console style experience, right? So it's not a big leap for them to go from prospecting and looking at what they're seeing in terms of mobile app-based gaming behavior and jumping to provision of cloud gaming, but not some crazy high experience level of cloud gaming, cloud-based mobile gaming, right? Massive library, they deliver over their existing network and CDN, and that is not a very far leap for them to engage in.
Not at all.
Like you said, it's a super high engagement genre. Why can't they just be a destination for everything you do when you want to watch filmed entertainment or gaming entertainment? So I think that's
So to that point, the two things that I'm kind of keeping an eye on them with is they're merging Disney Plus and Hulu, right? So they've sort of said they have it. So what's going to happen with that? Because that could be a really hot app. And then sort of almost part of that is they have to be looking at YouTube TV, which you mentioned earlier, Evan, and how much they're growing. And Hulu Live TV is not. And they're very, very similar. Rebrand it Disney TV and like push it. Like they could
Well,
get,
the question
you
is,
know.
as you said, I mean, I don't think anybody's profiting from the MVPD business, even the virtual MVPD business, which has a lower overhead.
One company. So
Which one?
you think it's an anomaly, but Friendly TV, right? They're small
Yes.
MVPD, but they were profitable as of early 2022 and with only 500,000 subscribers. And that's by concentrating on things that they knew were high engagement, or they focused on one audience, which is family-friendly TV. So they're a bit of an anomaly, but they're a good lesson for the industry. That's
Yeah,
all.
and by the
But
way,
if, but
there's
if you're
Angels
Disney,
Angel Studios is a very
Yes,
different kind of
yes.
business with the same market that's actually also hyper serving. But the faith-based stuff is become a really good, solid business to invest in, and you don't need 100 million users in order to have a real business. But you were
But I say super quickly, if you're Disney, one of your big profits is from carriage and retrans fees, right? So
You're
if you're
paying
paying them to yourself,
Mhm.
then
well, that was why Hulu got invented in the first place, and
Right.
Hulu now in retrospect.
So
Two
if
quick
you're
points.
yeah.
Go ahead. No,
No, I
go.
say if you have VM as opposed to YouTube, which doesn't benefit from that, like a Disney VMVPD with 10 million subscribers, that's a lot of money that they're sort of, getting out of that on the back end.
Yeah, no, it'll be interesting to see. I don't know. Like Disney buys into businesses and then doesn't necessarily run them all the way. ML BAMTech being probably the best example.
Yes.
I can give you a $1.5 billion acquisition that they haven't done that much with. And one could argue just the opposite. And so the MVPD arm of Hulu feels, and frankly, one wonders where all of Hulu heads ultimately. Does it just kind of fade into the woodwork, become part of the Disney ecosystem? But I think operating an MVPD may be not necessarily in their core competency. I don't know that they know how to grow that business. Really quickly though, two quick bullet points on data. Mobile gaming is a $200 billion a year business, bigger than almost any other sector of the media economy. More than half of the revenue comes from mobile gaming, and more than half of that revenue comes from ads. And so mobile gaming for Netflix and everybody else could be a really interesting extension of the revenue that they need to build, and different, for Netflix, a differentiated set of impressions outside the home, versus those. And by the way, the Venn diagram of solid Netflix subscriber and mobile gamer is a whole circle, right? It's a 25 plus female male mix, who is exactly who they get already. So I do think they have a solid strategy there. I think they're, pussyfooting it around, to be blunt, up until this point, and they either have to decide they're in that business or not. One last question for everybody, which comes from the Q&A. If you had one game changer that might happen this year, or that one thing that might be a game changer if it happened, what would it be?
Well, I think I don't know if it'll happen this year, but I think Netflix getting more into gaming and diverse. So, I mean, I think another really interesting thing about Netflix that's been sort of overlooked is not overlooked, but with the WWE deal, that's going to cost them per year about 2 Rebel Moons per year. They're going to get 150 hours of content from that. They don't have to worry about Rotten Tomatoes, and people are going to spend 100. If you like it, they're going to spend 150 hours engaged with that. I think gaming would do almost the same thing, where people will spend a tremendous amount of time in there, and they can sell ads against it, and the ads in video games don't piss people off the way the ads in TV shows do. It's a lot more elegantly put together. In many cases, if it's playable content, it actually enhances the games. So I think, especially after listening to the last earnings call, that they're doing them on YouTube now. But I think both the WWE and the gaming initiatives are sort of, to me, look like they're really taking meaningful steps into becoming that sort of that hub of all entertainment content, the first place that people stop when they want to do something entertainment based, no matter what kind it is.
I agree. Ophelie?
Yeah, for me, it's not really related to streaming directly, but more jumping on what you said when you mentioned the trade desk earlier, would be around the advertising segment going more towards data-driven things. I think also we see it increasingly with agencies, like all the major agencies, they're pushing a lot on their performance branches, which are very much set up across analytics and better understanding basically the metrics you get from TV and video. And I think that's where also a lot of people will go towards in the year coming and the one after also probably. I don't think people will be able to set up industry currencies very fast. So it might take some time, but I think that's an interesting one to look at.
And I
Definitely.
think what my thoughts kind of dovetail into that and some of what Alan mentioned earlier, the advertising market, we look at, what's a game changer? I think revenue generation, anything that's a massive revenue generator is going to be a game changer for a business that's incredibly profit challenged at the moment, right? Whether we're talking streaming, entertainment, what have you. And you look at the state of advertising, we have an advertising picture where there's a little bit of chaos, right? We have the demands for standardization and measurement and currency. And now we're coming to a cookieless world, and the issue of identity is incredibly important, right? How do we maintain identity in a privacy protected way across different apps and platforms and what have you? And that's why the Trade Desk is doing so well. Unified ID 2.0, maybe not the answer to everything, but at least it's a direction forward and the industry's responding, right? So some clarity there. But I think, as we look at the nature of consumption continuing to splinter off across mobile, at home and gaming and streaming entertainment, how do you really figure out how to effectively advertise to all of them? And we look at the tech giants, especially at Google, right? They have the #1 utilized operating system of any kind on earth. I thought it was crazy, but I looked it up in Android. They have obviously properties across streaming, across like mobile devices, what have you, computing, and they can give you a unified picture of we can hit this many,
And it's
people.
all inside a walled garden that they
Right.
control.
And so how do you compete with that? Very good question. I think the only effective way is to, on the other hand, on the other side of the equation, find a way forward collectively for the advertising industry and advertisers to be able to reach effectively across multiple platforms, devices, forms of entertainment consumption, and to be able to intelligently serve ads. I mean, that's it's pie in the sky, but I think that that's really something has to be done in that regard, and that changes the dynamics
Well,
of
and
revenue
I think in
generation.
the US, we're seeing that the industry wants multiple choices on how to do that.
Yeah.
The question is, who's going to be most effective, and if that gets commodified, who can actually make it profitable? Alan, what's your prediction or your
So I think,
your
yes, I
hope,
think
or
the
your
thing
hope
that's
for a game changer?
the thing that's going to change a lot of games, and it may not be, it's not 2024, it's over the next couple of years, is the rollout of IPv6. So right now with IPv4, without going into a whole tech thing, with IPv6 is sort of the next step of your IP address thing. Now, right now with IPv4, they can look at the number and know where you are, like down to a couple blocks. IPv6 takes that all away. It's constantly changing numbers on people. There'll be no way to track people in the way that they're used to. And that's just going to throw off so much of the tracking that the industry is used to doing in data collection. And they've got to figure out another way to do it. It's going to be a big sort of watershed for privacy as well, because suddenly people are going to go, oh, wait, you were tracking me and we don't want this to happen again. So that's going to be a big thing the industry is going to have to figure out for both advertising, for recommendations, for a whole lot of things that they have sort of been
Yeah,
relying
and
on
I think
that
it's
for.
going to gum up the works in a way that people aren't necessarily entirely prepared for. But
No, they're not.
I
No,
guess
they,
I get, and yeah, par for the course in this ecosystem. We're a little over time, so thank you, panelists, for sticking around for my keynote and offering commentary, siren song on the other side. I really appreciate your time on this. Thanks everybody for sticking around for all this great content. And this is a great conversation. I could do this. In fact, I'm just going to go off and talk to Alan and spend the rest of the day anyway. Thanks all of you for joining me here. The winner of our song contest was Warren Campbell. I hope he's still here. The song was Isaac Hayes, Be Yourself. He's the winner of an Amazon gift card of $50. We're going to have a whole suite of programming all week, panels and more presentations all week long here at Streaming Media Connect. Go to the link in the chat to see the whole agenda, and we'll see you soon. Thanks so much for sticking around.
Thank you.
All right, take care.
Thank you.
Bye.
You guys.